Welcome to the security analysis and portfolio management class on money market instruments. The first money market instrument is treasury bills. A treasury bill is basically an instrument of a short-term borrowing by Government of India to develop the treasury bill market and provide investors with financial instruments of varying short-term maturities and to facilitate the cash management requirements of various segments of the economy. In April 1997, treasury bills of varied maturities were introduced. 14-day treasury bills on a weekly basis was introduced from June 6th in 1997. The second half of 97 to 98, treasury bill of 28 days was introduced on auction basis. Further, it was decided to reintroduce 182-day treasury bills through auctions. Generally, treasury bills are of 91 days. Since the interest rates offered on the treasury bills are very low, individuals very rarely invest in them. Then who will invest there? The NBFCs and the banks and the other financial institutions, they will be making investments in the treasury bills. Commercial papers. Commercial paper is a short-term negotiable instrument with fixed maturity period. It is an unsecured promissory note issued by the company either directly or through bank or merchant banks. The maturity period of commercial paper was originally 3 to 6 months from the date of issue. In October 1993, the maximum period was extended to 1 year. The commercial papers are sold at a discount and redeemed at their face value. For example, commercial papers worth is 1,000 rupees means it is issued to the general public for rupees 950 or 930 or 907. So that at the time of maturity, when it is redeemed with us, then we will be collecting 1,000 rupees from the company. Till that, we will be receiving the interest also. The discounted value implicated the interest rate. The denomination of commercial paper is high. Mostly the companies and institutional investors favor them. The minimum maturity of commercial paper was brought down from 3 months to 30 days. The third one is certificate of deposit. The certificate of deposit is a marketable receipt of funds deposited in a bank for a fixed period at a specific rate of interest. They are bearer documents and readily negotiable. The denominations of the CD, that means certificate of deposits, and the interest rate on them are very high. It is mainly preferred by institutional investors and companies rather than the individuals. The minimum size of certificate is rupees 10 lakhs. And the additional amount is issued in multiples of 5 lakhs. Repurchase agreements, repo. Loans of a brief period that are agreed upon by buyers and sellers for the purpose of buying and selling are referred to as repurchase agreements, repo. Sometimes known as reverse repo or simply as repo. These transactions can only be made between parties that the RBI has approved. Transactions involving repo or reverse repo can only be made between parties that the RBI has permitted. Only transactions involving RBI approved securities, such as treasury bill, securities issued by the federal, state, or local governments, corporate bonds, and public sector units bonds are allowed. Banker's acceptance. A banker's acceptance, often known as BA, is essentially a document that guarantees a future payment and is issued by a commercial bank. Banker's acceptance, which is used in money market funds frequently and is similar to a treasury bill, stipulates the terms of repayment, including the amount to be repaid, the date of repayment, and the information about the person to whom the payback is due. The durations available with banker's acceptance range from 30 to 180 days. Thank you.